Good morning, everybody. Let me begin by thanking the organizers for inviting me for this great event. My name is John Baffes. I'm a senior economist at the World Bank, and for the past several years, I have been leading the work on commodity markets, including managing the commodity price database, as well as managing the commodity price forecasting process. My presentation is going to be covering basically two aspects. The first is going to be the macroeconomic conditions, and the second is going to be some detailed comments on the recent developments and forecasts on global commodity markets, including energy, agriculture, and time permitting, I will touch upon fertilizers a little. And at the end, I'm going to give you the outlook and the risks to global commodity markets. The presentation is going to be a bit dense, so I'm going to go quickly through some of the slides. Apologies in advance for this, but I'm going to be available for the rest of the conference. So in case you have any questions or discussions with me, I'll be more than happy to elaborate. Let me begin with the global macroeconomic conditions, and what we see in this slide on our left is the history, 3 years history of global growth, as well as 2 years of forecasts. The historical global growth comes for our team, the World Bank Prospects Group team, but the forecasts come from another company. And the reason we do not show our forecast is that our latest forecast round, which was done back in June, is quite outdated. We are preparing our next forecast round for global growth for the next edition of the Global Economic Prospects, which is going to be published in January. And as you know, between June, when we published our growth forecast, and now it looks like an eternity. In terms of numbers, we expect global growth to average 2.6% this year and to slow down 2.4% next year. For the commodity perspective, we'd like to divide the world in two kind of parts: the advanced economies on the one hand, the emerging markets and developing economies on the other hand. The reasons we do that, and again, let me highlight the fact that this is very important for commodity markets, is that emerging markets and developing economies are the group of countries that are most important for commodity markets. That's where most of the production, consumption, and trade of commodities takes place. For 2025, the expectation is that emerging markets and developing economies are going to average growth 4.2%, which is the same as last year, the 2014, and some slowdown is expected for 2026 to 3.9%. In the chart to the right, we're showing how the evolution of forecasts for 2025 and 2026 materialized throughout last year and the 3 quarters of this year. It's kind of an interesting picture because throughout 2024, beginning in February 2024, when forecasts for the 2025 year were first published, the expectation was that the growth for 2025 will be 2.6%. But with fears about trade war and the various geopolitical issues, the expectation was reduced back in the first and second quarter of this year. But fortunately, lately, the expectation has gone back up to the 2.6 that we expected early in the year, last year. So, to summarize, the picture of the global economy may not be perfect, but at least it's not as bad as we expected a few months ago. Two other aspects in the global economy that matter a lot in commodity markets are exchange rate movements of the US dollar and interest rates, for obvious reasons. To the left, I'm showing you the nominal broad US dollar index, and we see quite a bit of depreciation that took place over the past 3 quarters since January of 2025. pretty much in the order of 8 to 10%. Now, although this depreciation has received a lot of attention by the press, the popular press, the media, as well as various analysts, when we look at a bit of a longer term perspective, and in this particular case from January 2022, we see that we had a similar degree of depreciation that took place back in the first and second quarter of 2022. So it's not unprecedented by historical standards to see this kind of depreciation. And of course, that was preceded in both cases by quite a bit of appreciation of equal magnitude. In fact, back in the early 2022, the appreciation of the US dollar was much larger, stronger than one materialized in the past few quarters. Now, the reason, of course, the US dollar is very important is because there has been a well-researched and established negative relationship between the movements of the US dollar and the commodity prices, and that's because commodity prices, or rather most commodity prices, the international trade, are invoiced in US dollars, and therefore when the US dollar moves, commodity prices move in opposite directions regardless of what happens to the fundamental of commodity markets. To the right, I'm showing you the interest rates as they have been evolved in the United States. I'm showing you the federal funds rate, which is published by its manager, rather by the Federal Reserve, which is the central bank of the United States. And this is a familiar pattern. We started back in the early 2022 with near zero interest rates. We had an interest rate hike from near zero to almost 5.5% within a space of a year and a half. And of course, the reason for this hike was to contain the inflation, which was a big concern back in 2022 and 2023. Most of the central banks started reducing the interest rates late last year and this year. The Federal Reserve of the United States was engaged a bit later in reducing the Fed funds rates. There was a reduction that took place early in the year, then there was a pause, and we had an interest rate reduction of 0.25 points just a few days ago. The expectation is that the Federal Reserve is going to reduce the interest rates. Probably it's going to have maybe 2 to 3 cuts for the rest of the year, but that might change depending on how the inflation is going to materialize. To summarize, in terms of the global picture, we have global growth, which was of concern as of a few months ago, but now it has returned to the kind of average growth that we expected last year and the year before. We have a depreciation of the US dollar, which is, as I said, it moves in opposite direction of commodity prices, but that depreciation is not unprecedented by historical standards. And we have a declining interest rates, which in the case of the United States have been a bit late compared to the other central banks. So that's pretty much the global macroeconomic picture. Let me now move to commodity markets, and in this slide I'm showing you the 3 main commodity price interests that are indices that are of interest to this conference. It's energy, agriculture, and fertilizers. The energy index consists of the 3 main commodities: crude oil, natural gas, and coal. Fertilizers are the 3 usual suspects, NPK. And the agricultural price index is a very broad index which covers commodities that are from the food group, grains and oil seeds, but they also cover some other commodities such as raw materials and beverages, including coffee, cocoa, etc. We see here a period of stability prior to the pandemic. Quite a bit of volatility. It's what I call a heightened risk period, which includes the pandemic, the Ukraine war, and the conflict in the Middle East. And then we moved to a more stable commodity price movement environment after 2023. When we compare commodity prices for the past 3 quarters with how commodity prices averaged in the first 3 quarters of 2018, which is 7 years ago, what we see is that energy is pretty much the same, just 4% higher. Agriculture is 32% higher compared to 7 years ago, and fertilizers are 74% higher compared again to 7 years ago. Now, let me highlight the fact that those are nominal prices. There has been quite a bit of inflation between then and now. Inflation measures differ a lot. the definition of the global inflation is a very it's not as well established as other magnitudes, but our assessment is that global inflation throughout this 7-year period is about 30%, which makes the agricultural price index pretty much the same in real terms, energy prices 25% lower, but fertilizer prices still close to 50% higher than what they were 7 years ago. To move focus a bit deeper into the energy prices, what we see now is that we had quite a bit of reduction, decline in the prices of oil after reaching nearly $100 per barrel back in early 2022. Oil price have declined a lot, and as I will show you later, there's both weakening demand on one side and pretty much strong supplies on the other side, on the supply side. In the middle, I'm showing you the natural gas prices. Typically, we have three measures of natural gas prices, or rather representing three markets. One is the North American market, indicated by US here. Another is the liquefied natural gas market. The main sort of place in the world is East Asia, where the price determination process takes place. And the third market is the European natural gas market. And you can see that all three natural gas prices pretty much increased during the period which encompasses both the pandemic as well as the Ukraine war and the conflicts in the Middle East. Now prices of natural gas have come down. In real terms, some of them are the same as they were prior to the pandemic, but the ones in Europe are quite higher than prior to the pandemic. The same picture is in coal. You can see that coal prices and natural gas prices move in tandem, and that's not surprising because both are used for electricity generation, and there's some kind of degree of co-movement because of the substitutability to generate electricity. As I said earlier, there's quite a bit of increase in oil production. That's why we see kind of weakening crude oil prices. What's interesting is that the United States has emerged as the global leader in terms of global oil production. It now accounts for more than 21 million barrels per day, just the United States alone. To put this number into perspective, the world produces a bit more than 100 million barrels per day, so the United States accounts for more than 20% of global production. In fact, the United States produces a bit more oil than Saudi Arabia and Russia combined for the past few years. It's important to highlight the fact that when we measure oil production in the United States, we account for both crude oil production as well as quite a bit of natural gas liquids that become that are accounted in the crude oil production. Two observations that I would like to make about Saudi Arabia and Russia, the chart to the right, are the following. The first, we see that Russia, despite all the sanctions that have been imposed after the war in Ukraine, we see that Russia was able to maintain pretty much the same level of exports as it did prior to the invasion. That's one observation. The second observation is that you see that Saudi Arabia oil production has increased recently, the past few months, and that reflects the fact that they have begun reversing the cuts that they were initiated about 2 years ago. In fact, in this chart, you can see clearly into the chart to the left, it's the OPEC plus capacity, which includes the OPEC countries plus Russia and some other important oil producers. And you can see that capacity had reached a maximum of 7 million barrels per day, but it started declining recently because some of the capacity went up to actual production, and that reflects, as I said earlier, the reversal of the cuts that have been undertaken by the OPEC plus, most of which come from Russia, for Saudi Arabia, and you can see that in the dark blue line, which goes down as for the past few months. Now to the right, I'm showing you what the industry calls the rig count, and the rig count is a kind of metric that is used by some analysts to project, so to speak, or to forecast oil and natural gas output in the United States. And it's basically it's a count of the active oil and natural gas operations. And again, this is a very rough, very crude measure of future output. It's interesting that you see the oil rig count goes down, which implies that because oil prices, especially the WTI, which is the barometer used relevant to the United States, has been not very low, has been low by historical standards. It has dropped below $60. And a price of US oil below $60 make quite a bit of the large portion, a good portion of the US shale oil industry uncompetitive, and that's why we see a decline in the US oil rig count. On the contrary, what we see in the natural gas rig count, it goes up, and that's because the United States is expanding natural gas production, especially for LNG exports. On the demand side, very interesting observation to the left, we see the solid line, the solid red line, which shows the long-term growth in global oil demand, which is about 1.5 million barrels per day. Again, the relevant number to compare this is to compare with global oil production, which is about a bit more than 100 million barrels per day. And what we see that in 2023, most of this growth came from China, and that because China was late in opening its economy after the pandemic. So most of it was accounted by China. But what's interesting is that the projection, the 2024 demand for China, as well as projection for 2025 and 2026, it's very little growth. Almost zero growth, very little. And the reason is that China has electrified most of its passenger cars, and it has used natural gas for its truck fleet. Let me move lastly to the last part of the presentation, which is the agricultural prices, and we see that we have declining agricultural prices. Most of agricultural prices are higher, of course, in nominal terms compared to 7 years ago. But as I said earlier, if we take into account inflation, which is about 30% in real terms, they are much lower. For the current season, the ongoing season, the global grain and soybean production output is quite comfortable, or for commodities which account for 2/3 of global calorific consumption, pretty much those 4 commodities feed the world, I would say. They are on the positive territory, and 2 of them, maize and wheat, are even above long-term trends, which is why I call the agricultural commodity outlook for 2025-26 comfortable. And you can see here, when I aggregate all grains and all edible oils, the light blue line, which is very close to the long-term average. Let me, in the interest of time, show you the last slide, which is the fertilizer prices. And what we see in fertilizer prices, contrary to other commodities, we have a spike for the past few months, and that has made fertilizer affordability a bit lower, which is indicated as higher to the line to the right. But the energy affordability index is quite low, meaning it's stable or the same, I would say, as it was prior to 2020. Just to conclude my presentation, what we project is for 2025 is that pretty much declines for 2025 for most commodities, major declines, some less declines in 2026. Exception to this is fertilizer prices, which are expected to go up, and there are 2 other groups of commodities that are expected to go up, not shown here, which are precious metals and beverages, which means coffee and cocoa. Now, let me emphasize that those forecasts were published in June of 2025. We prepared those forecasts in May of 2025. We're doing the forecasts round again. We're going to publish it next month, at the end of the next month. My assessment is that for 2025 and 2026, we are having a bit even more negative declines in commodity price, except fertilizers, which again is going to be on the positive territory. With that, I would like to conclude my presentation. Again, I would like to thank the organizers for giving me the floor to summarize the global commodity outlook and the global market outlook. As I said earlier, I'm going to be available for the rest of the conference. If you have any questions or concerns, comments, please let me know. Again, thanks a lot, and here's the website which has all the material, including the presentation which I just made.